One morning, you open your banking app and see it. Your loan payment has increased. You didn't borrow more money. You didn't miss a payment. You didn't change anything. But interest rates went up, and now your monthly payment is eating a bigger chunk of your income. This is the reality for millions of Americans right now. When central banks raise interest rates to fight inflation, the effects don't stay in government buildings or financial markets. They show up in real life. They show up in your mortgage payment, your business loan, your car loan, and your monthly budget. The frustrating part is that many people feel trapped. How am I supposed to manage this now? The answer starts with understanding that higher rates change the rules of the game. The businesses and households that survive these periods are not necessarily the ones earning the most money. They are the ones that adjust the fastest. That means reviewing expenses, renegotiating debts where possible, improving cash flow, building additional income streams, and making financial decisions based on today's reality instead of yesterday's conditions. HIG rates are difficult, but they are also temporary. Every economic cycle eventually changes. The question is not whether rates went up. The question is, what adjustments are you making to stay ahead while they remain high? When interest rates rise, most people focus on the headline. The Federal Reserve raises rates. The news talks about inflation. Financial experts debate what happens next, but for ordinary households and business owners, the story is much simpler. A higher interest rate means borrowing becomes more expensive. Your mortgage payment may increase. Your business loan may cost more. Your credit card balance becomes harder to pay off. Your vehicle loan suddenly takes a bigger bite out of your monthly income. And that leads many people to ask the same question: how am I supposed to manage this now? The truth is that rising interest rates create financial pressure, but they also reveal something important. They expose the difference between reacting emotionally and responding strategically. Smart borrowers do not panic when rates rise. They assess, they adjust, they adapt. The first thing smart borrowers do is understand their numbers. They know exactly how much debt they owe, what interest rates they are paying, and how much of their monthly income is committed to debt payments. You cannot solve a financial problem you have not measured. The second thing they do is focus on cash flow. Many people think wealth is about income. In reality, survival during periods of rising interest rates is often about cash flow. A family earning $120,000 a year can struggle if every dollar is already committed. A business generating strong sales can still experience financial stress if cash is leaving faster than it is coming in. That is why smart borrowers review subscriptions, recurring expenses, unnecessary spending, and inefficient business costs. Every dollar saved strengthens financial flexibility. Third thing they do is attack high-interest debt aggressively. And all debt is equal. A mortgage at a reasonable rate is very different from carrying a large credit card balance at a much higher rate. The faster expensive debt is reduced, the less vulnerable you become when rates continue climbing.